what's going on, guys? Funny facts, is that fair? What's up? Before I jump on, if anyone's got any questions or anything they'd like to know or just have a general conversation before I jump on. I was going to do it on Instagram, but I wasn't sure how to actually set it up, so I ended up just doing it on YouTube. Let's see, have you guys got any questions, anything you guys are trading, what are you guys looking at? GU, let me have a little look at GU. Yeah, definitely. It's definitely going to be a nice week this week. GU, oh, do you know what? GU's nice. You're looking for the long, right? Or potential if it does develop into a larger short. I can see both sides. Hey, what's going on, Just Trades? Yeah, no, definitely. Do you know what I like a lot about GU? Is that it's selling off, but it's given a lot of opportunities to sell off to those value areas, and now it's kind of just a case of, it wasn't GU, what was it? Waiting for GU. Okay, cool. Yeah, no, to be honest, for me personally, I haven't got GU on watch, just because how it's moving is kind of a little bit more irregular to the sort of price action that I look for. Something that kind of worked for me, helped me get to levels of consistency, was trading certain market conditions that complemented my style of trading. So for example, let's say price is tapped into a value area, I will evaluate how price is moving away. So if it's my typical type of sequence, then I know that that's much more higher probability in terms of my trading plan. Whereas if I'm getting into something where, let's say there's a near miss gap just above and it's pushed away and price is a little bit corrective and it's moving away, I will naturally just avoid that trade and I'll just kind of take it off watch and then accept the fact that there may not be a trade for the day or the week, and it is what it is. And I think those are the sort of things that, you know, help you build that niche within your trading ability. A lot of people, they want to kind of just jump into the first push and a flag situation. Like if I just show you that trade on GU, see if I flip this one sec. Here we go. So if you look at this, oh, here it is. So you know you got this larger flag here, where price basically had this section here. You see how you had that insurance entry there? That's clear as day. That was your base. That was your. It did come up and tap into this area, but you can see that there was this huge gap up here. So it was like, well, if it sells off, why would it create all of that? So then you look at it again and it's like, okay, push up, push down, created a base, retraced back over there, created the insurance entry, and then it went. And then when it went, it filled in that little bit of liquidity there, but it still left a gap to the high. So it sold off, didn't give us a nice continuation in any of these areas, sold off again, tapped into the low here, pushed back up, left a gap there, and then sold off correctively, came into the low again, and now we're here. So that's why I'm kind of a bit neutral, because in the same way we saw price do this, where it tapped into the high and then came and created this, we might be seeing something similar here, where now we're at that low. What if we create something a bit larger in this section here to continue lower? And it's kind of just seeing that so many times that you kind of start to realize that there's a lot of types of trades you want to stay out of, and there's a lot of trades you want to get involved in. But at the end of the day, like, I realize even if I'm up 8%, and like, for example, if we look at GU right now, and GU is shaping up and it might kind of look good, I'm gonna flip it back and just have a look at that again. So you see here, you've got GU pretty much shaping up here where you're kind of at the value area low. This was a failed continuation, but when you do look at it, it's a correction into another correction. So then this is kind of becoming one large piece of correction here. Even though there's the potential for a trade here, you have to ask yourself, is it worth the risk? And for some people, they could say, yeah, you know what, I'll take that risk. But how many times would you take that risk to then realize that it's not the type of trade that you want to get involved on? If I go to the 15-minute, you know, again, you can see it. These boxes are actually just stating the sessions. So something that I've been doing in the background that's really helped me as well, which some of you, if you want to know what indicator that is, it's called Lux Algo Sessions, and then I changed the colors. This really helps you. Now I'll show you something, right? If I look on the hourly and you look at when the sessions are opening and closing, for example, like you can see New York session open, price dropped. New York session, again, over here, price dropped. Again, New York session. So it's kind of helping you get positioned at the right time as well. It doesn't always necessarily have to be bang on a certain time, but it shows you, sorry about that, my dogs. It shows you that sometimes it's best for you to know when to be active in the markets and when to walk away. Because a lot of the time, a lot of people, they'll be jumping into the markets any time of the day. And because they trade like that, they're more prone to taking a lot of unnecessary trades. Where for someone like myself, what works best for me is I'll take a trade. This is my trading plan as well, if you want to see it. It's a bit like this. And essentially what I'll be doing is I'll be taking a trade, let's say New York open, London open, first 2 hours, and I'll look for my trade to be shaped up there with structure. And if I don't get it in that period, then I'll walk away and enjoy the rest of my day. I think a lot of people, they want to have that sort of approach, but their impulsivity gets the better of them. And then what happens is they end up taking too many unnecessary trades. And then as a side effect, they end up not making any money at all. So you kind of have to find that balance, that timing, and also just realize that when you're a very successful, profitable trader, it's very likely that you're not going to be trading every single day. You're not going to be trading every single minute of every day. And when you kind of come to those levels of realization, yeah, your trading will get a lot better. So, let me read some of these questions. GU, not much this week. View on EAGA. Let's have a little look at EAGA. So I've got GA over here. Do you know what? GA is actually one of my least favorite pairs to trade. Just because, you know, if you've traded it long enough, you know that it's not always presenting the goods. Let's have a little look. So, oh, okay. I see what's happened here. So we had some huge volatility coming to the market, push market up, and now it's correcting. Do you know what, right? This is an interesting one with GA. I'll just flip the screen here as well. And if I go to the 4 hour, you can see how, if I just clear that bit off. So you can see something here which is very interesting. Actually, let me take off this session. You'll see this here. Price came up, tapped into that little bit of liquidity, and it just started selling off. In some ways, if you zoom out and you look at it this way, you can see that, okay, we had the sort of origin of that correction there, and then price spiked up and tapped into the origin there, and now it's selling off. So there is two ways I'd look at this. I would see it as a potential sell, but also I'd be cautious because all of that was corrective and it did come into that level of a base there. So it being in this area is quite a risky area to trade right now, because the positioning isn't the same as when you're trading on the way back down here. You're kind of at the low now, so you're kind of waiting to see, is this going to be a correction to move to the downside, or is this going to move to the upside? And you don't really know at this point because you're stuck within that final part of its range, and it's not supported by the best structure. When you look at it, it was a corrective squeeze, which arguably you could say that had a 3-touch into the low, corrective squeeze into this area, then pushed up. So I think something that a lot of people do need to come to the realization when they're looking at this price action is it's not going to be your best price action to go to, and sometimes you're better off looking for something else. If you're in a funding assessment and you're still trying to reach consistency, personally, I wouldn't try to mess around with too many of these. I would look for your bread and butters, something where, let's say it's tapped into a value area here, it's pushed away, it's broke the low there, it's then created continuation here, it's cleared that, it's then created another continuation here, cleared that, then created another continuation here. You know, and those are your sort of ones that are going to make you money, because you can get in so precise in a lot of these, and you know, 1 or 2 of these trades can just land you with 8-9%, and you're pretty much moving forward. Whereas what you can see here is that it's not necessarily wrong, but at the same time, it's like I'm at an area where it's not really where I've got the best of edges, because positioning isn't the best. So what you want to be doing is you want to be getting clear trading criteria, where let's say you had something like this, and then you had a clear 1, 2, 3, it's met all your criteria. Then within this sequence here, you've then been able to get positioned in trade 1, maybe even 2 trades in there, another trade in here, another trade in there, another trade there, and then you've cleared the low, you're getting another continuation in there, you've been able to get into another trade in there, you know, these sort of things. That's how you're going to reach like high levels of consistency for waiting for that run. Trying to get involved here, you're asking for a mess, you know, because what I was doing for a long time as well is I was jumping in on a lot of these trades, and then I wasn't looking at what I wanted. And what I really wanted is, and I'm sure a lot of you can resonate with this, is you want to get into a trade, but you want to be able to walk away from that. And when you do walk away from it, it's like, okay, great, well, I don't need to now keep coming back to the charts. I don't need to check it if it's running. I can move to break even simply. You've gotten in over here. Price has then cleared that price action over a couple hours. You've left your stop loss there, and price is just moving away. You can get in that because you're basically trading the higher time frame. You understand what's basically happened in this area. You know what's highly probable, and then you understand that if this is going to be like quite an impulsive momentum-filled run, like we saw with the DXY, you can get involved on those. So I'd be conscious of that. Not to say that this can't just sell off from where it is now. It's just you're within all of this, and for me, it's not something that within my sort of data that I've collected is something that I want to really be jumping in, because sometimes it can lead to an unnecessary loss. GA can have really crappy spreads, and then it's, you know, one of them ones where if this gets corrective, gets down to the wrong time zone, like Asian session, spreads come out, and then suddenly I've been taken out, and then the next day it's kind of fallen off. I've seen another continuation. I tried to jump in on that. It then wasn't really the one, became corrective. This became a middle section. This then became something larger, came back up, and then we had that. I would much rather wait for this and then take advantage of that sequence than try to get involved in something there, if that makes sense. Let's quickly have a quick look at EA. EA, usually they tend to move the same way. So, you know, at the end of the day, you know, if one's going to move, the other one's probably going to follow. Yeah, so strong impulsive movement there, push down. Personally, if you want to take full advantage of this, I would look at it in the sense that I would be waiting for, most likely at this point here, this is just not looking too good. It looks like it could just probably do something like that, and then it just becomes this, and then start back into those areas, and then possibly we could take advantage of that type of run. Again, it's one of them ones where I don't think that it's necessarily the worst trade in the world. I think it's definitely a strategic play, but it's one of them ones which can be short-lived. And a lot of the time, I'm not looking for them short-lived trades. I'm looking for ones where I can get in and I can scale in and I can put all my focus in one particular pair for a short while and get out with 10, 13, 14%. Whereas getting in for those small wins as well is great, but at the same time, it's like, what opportunity cost? And there's certain pairs that have really, really bad spreads. So if I know that it's one of those pairs, I know it's a trade that I'm just going to get in and out of. And if I'm going to get in and out of it, it's literally going to be, you know, a trade like this where I've got my value there, prices then come up, tapped into the value, pushed away, given me continuation, and then I know by the end of the day I could probably get out for 4% in this area before spreads get wild, or it could retrace, but I could pretty much manage that pretty aggressively, because if you go through your trading data, how many EA, GA, EN, for example, trades have you held for like 3-4 days? Probably not many. You're pretty much looking for a trade that you can take advantage of in these areas, and then you're probably out the market by the time it gets to like one of these areas here, and it taps into maybe, you know, some volume to the left, and you're probably out somewhere here. That's usually the case with a lot of us traders. We're not looking for capital. Well, we do want to, but we're not usually capitalizing from here to here. It's not usually the common situation where we're holding the trade from March all the way till mid-April. You know, I don't know how many traders here have been holding trades that long, but something to keep into consideration. Let's go through the next question. So how often do you use AFT versus 4-hour entries? Good question, very good question. I'll be honest with you, as much as I understand the 4-hour entries and AFT, and I've traded AFT much longer, I prefer the 4-hour confirmation. So less about the 4-hour entry itself, but the 4-hour confirmation, and that opens the door to everything else. So the time I would use a refinement entry, an AFT entry, which for those who don't know it, it's a 5-minute, using the 5-minute time frame opposed to using a higher time frame for a more sniped entry. I would say it's situational, but less. The AFT entries are not being used as much as the 4-hour entries, but when they're used very well. So probably I'm using it about 70% 4-hour now and 30% AFT, but I'm making more with AFT in one particular trade. So basically I would wait for example, weekly and daily value areas or even 4-hour value areas to be met. And then after we've had the 4-hour confirmation, I could potentially be looking for a 4-hour confirmation, or I would be waiting for a AFT entry if I was looking for something a little bit more precise. I wouldn't take an AFT entry if I was in drawdown, and I wouldn't take an AFT entry if I was in below 2% profit for the week. Just strict criteria, because with AFT it's kind of like a black hole in the sense that you could just take quite a lot of 5-minute flags. You can take 5-minute trades everywhere. You can get caught into a mess, especially not having a lot of experience. So it's not my go-to, but I know a place where and when to take it. For example, when we hit those high value areas, we've come in with structure, we've had a clear 1, 2, 3, we've then pushed away, we've confirmed on the daily, the 4-hour, we've got 1-hour momentum. Every time frame leading up to the 5-minute looks good. That's the only time I would really want to take it, because it's like I don't really have many negative confluences to go against me, and everything else is aligned. So if every other time frame is a tick and then the 5-minute falls in place, I don't see why I wouldn't take advantage of it. So it's like I said, there might be a time, a 3-month amount of date, where I take more AFT entries than 4-hour, but the majority of the year I'm looking at the 4-hour mostly, because it's safer, it's less risk reward, but it compounds over time. At the end of the day, if you're not funded, it doesn't really matter to you if you're making money on AFT or you're making money on 4-hour. The whole idea is I need to get to a point of making money. So for me, it's like, if you want to start making money, stick with the 4-hour first, stick with the 1-hour, and you'll probably make money more consistently and much more safer with less amount of errors than you would on the 5-minute. Morning, thinking not involving in the markets for a few days because Friday crash gaps. All right, cool. Listen, Friday crash gaps, obviously we always get told it's news related, but a lot of it is profit taking. A lot of it is going to recover, it's going to fill the gaps, and then basically a lot of trades are going to shape up. Gap trading is a skill in itself that I think a lot of people do need to study and learn. So you notice that within the next 48 hours of a gap, it usually gets filled. If it doesn't always have to get filled, but the majority of the time it does. You can take advantage of something like that as well. There is a whole trading strategy in filling gaps. It's not always necessary. Gaps are always going to happen. It's a good thing you can experience them in live market conditions. I think stepping away from the markets in certain times is a smart thing to do, because gaps are irregular and they're not something that you can always price in. But what I do know is, and this is a great tip here in itself as well, if you've got a bit of price action, let me just move this chart off. Yeah, so if you've got a bit of price action like this, and let's say price is created, let's say that's the first top, so it came from somewhere, that's the first top, came up, then created the second one, that's your bottom, that's your second top, and then let's say there was a small gap in there as well, right? It's then come in to create the base. And then what's happened is you then got a crazy gap, and the gap did that. And then it came back up, right? You wouldn't necessarily price all of that in, right? You don't price that into your structure. And if you just study it, you'll see it like this, and then it came in, recovered, and then continued, came up, created the three tops there, eventually, you know, did its thing, came down, slapped in here, and then it went. And then you'll notice, but what about all of that irregular price action? Some of you here probably already learned from this, but that's a very strong commonality. You don't need to price all of that in. You can just look at the structure like this and like that, and then that's your structure to go. You'll notice that time and time again. I think EU, GU is a great one to study on that, and you'll notice this as a commonality because, you know, we get ISM, we get CPI, we get NFP, all of these things come into the market and then they affect our technicals. When you learn to kind of read through the noise of the volatility, because it's not really priced in structure, you'll be able to kind of see through a lot of things and still take advantage of markets when they do start gapping. So bear that little tip in mind. I was looking to buy GBP Aussie, but it's not forming any structure for a buy. Yeah, I mean, do you know what? GBP Aussie as well, it's, like I said, it's not my favorite pair, but I think a buy is could potentially be a smart play as well. It's just, right now you're in a corrective squeeze to the downside. So, you know, either way you're playing it right now, you're in a very neutral area. I would personally always just wait for clear structure. Even though it's kind of come in, tapped into value area, it's how it did it which is so important. Like what we see here is, look how it came down. It came down so corrected, then it just spiked up. That's not your regular structure at all. Even though it tapped into the value there, that's not your regular structure. Now it's coming down. Even if it gave you a little correction here, it's not really the best in the world, man. You're much better off waiting for something that repeats itself and you can take advantage of. Because ask yourself this, if you took a, let's say, extremely clean continuation here, would you be happy if that then developed and came back up? And are you in a position to take that trade? And I think, you know, at the end of the day, it's how you want to build your consistency. Because if you've got 10 trades and you took 3 of them which look like that, would that really meet your trading plan? In your trading plan, do you have a trade that looks like this? It may have the criteria of, yeah, but it's at a low, it's through the low, and it has a continuation. Okay, that's one criteria, but then look at the overall sequence. This is like a piece of large correction here, volume, a massive impulse, and then we're kind of sitting on the low, but we came back up with volume, and now we're kind of just, we squeezed into that break, which arguably had a 3-touch into it, squeezed into it, mini double bottom there as well, pushed up aggressively, and now it's retracing a bit. If that continued shooting up, you wouldn't be surprised. Neither would you be surprised if that came back down and retested that low and developed into something larger. So that's why I say just wait for something which is very clear and doesn't hold too much risk, because again, you're a risk manager. Your whole reasoning behind trading is to protect your capital, and I think in these scenarios, the best way to protect your capital is by taking a step back. Bro, what was the indicator for the trading sessions? Yeah, sorry about that. It was, the indicator is called, quickly go here, sessions, Lux Algo, this one right here. It's right there, Lux Algo, and then it just pops up. Obviously, you know, you can take it off and put it on, but extremely useful tool. Like if I just go use it on GA quickly, you'll see commonalities and patterns. For example, you know, you can see during the open what pairs tend to commit. You know, you can see that over here as well. If we're looking at GA, you can see price then comes in 1, 2, 3, taps into the liquidity there. London to New York session opens, sell off, then breaks the low, clears that liquidity, taps into the small continuation there. You've got liquidity up here sitting at multiple areas, so it's not really the best in the world. But again, you can see London session open, commits, New York session, the correction comes into Tokyo, sorry. Then in Tokyo, after swaps, it drops off. You know, and then you can just see time and time again how price is formulating. Obviously, you know, it's not always going to give you the most accurate, but if you're trading like myself, session to session, and you know that you're doing your pre-market preparation, you're planning for London session, and then I also do an afternoon forecast because I trade London and New York. I know that, okay, liquidity is most likely to come into the market around about 1 p.m. UK and 2 p.m. UK, and then London open, first 2 hours, for example, or 2 hours prior. So I would make sure I'm well prepared for that, and then I would essentially be having data like this collected in the background. So the more you recognize this data, for example, I'm looking at GA and I know that it has a tendency to either commit during New York session or even Asian session, and the occasional London session, but most likely New York session and Tokyo session, it has a really good hit rate of committing. I know that if there's a correction forming through London, New York, the likelihood is going into Tokyo session, we may potentially see impulsive action. So I could take advantage of that. And I know that it's not really necessary for me to be sitting there and waiting. I'll show you another example over here. So you got this larger correction piece here. It then broke the low and created that little continuation there. You can see how that continuation formed during New York session. So you had the New York impulse, then the rest of the New York session into Sydney session, which is Australian session, corrected, and then Tokyo session opened, committed, and then it just went. Right? Okay, London session had a massive spike and came back up, fair enough, but you can kind of just see how the methodology of just understanding sessions can really just help you get positioned well and be a bit more patient, because you know that, for example, if I'm halfway through London session, is it necessary for me to jump into a trade? Not all the time, right? Sometimes, yeah, like a rare occasion, but I know that the majority of the liquidity is going to come into the market around about New York open. So is it better for me to potentially wait for New York open, which could be in 2 hours from now, because the data is showing me that we get huge volatility, and then I know, okay, cool. Prior to New York open, what I'm going to do is I'm either going to place a pending order to get tagged in case it gets impulsive, or I will wait for the next hourly close. You know, you can make these decisions, and I think keeping it like that session by session, you save yourself a lot of time. And also remember this, you can apply it to the 4 hour. So that also adds an additional layer to you, where if you're working and you don't have a lot of time and you want to trade the 4 hour, you can see, okay, how often does price commit during the 4 hour and in what conditions, and how can I plan accordingly? So then you know that London session 4 hour candle, that's not the one I'm waiting for. I'm waiting for the one after that. And then it's like, okay, great. I can see that New York session seems to be the most likely for this particular pair to commit. Now I've got a list, right? Your Sunday market breakdown, you've got like a side list where you're like, these are the pairs that likely commit during New York session. These are the pairs that likely commit during London. Doesn't mean they can't commit during the other sessions, but I know that if I'm keeping, let's say, CJ on watch, the likelihood is there's going to be a time this week where I'm going to have to stay awake during Asian sessions to take the trade. So is that something that I can price in? Is that something that I'm able to do? And if it's not, then it's like, well, is it worth me putting CJ on watch? Well, I can have it on soft watch then, because it's not going to be a major priority. So certain things like that. Bro, what was that indicator? Yep, okay, cool, I gave you that. There was a beautiful trade on GA last week, which I took, and banked some profits. Nice. I was just looking at GA. I mean, GA's been crazy right now with the massive impulsive behavior. I use 1 hour more, else missed the 1 hour. Yeah, I mean, again, it's review that data. When you review your data, your trades, your past trades, you start to realize which timeframes you have more of an edge in and which other timeframes you need to work more on. But if you primarily make a lot more money and less losses on the 1 hour, just try stick with the 1 hour as much as possible. Don't go any lower. That's the key. Where a lot of you guys, including myself, lost a lot of money is when I was going to the lower time frames unnecessarily. And you know, it's an easy habit because we want to make money. You know, we're sitting there waiting for the 1 hour, it's looking dead, we're not seeing anything. At the same time, there is still a lot of trades going on, it's just we're not catching them. We then feel the urge to go to the lower time frame because we missed it, but that urge for you to go to lower time frame is not coming from a place of making money, it's coming from a place of lack because you've missed something. So then what's happening is an essence of FOMO is coming into your trade, because the action of going into the lower time frame is basically you telling yourself, we'll find a trade here. That's why we're going to a low time frame, but technically it's not always necessarily the case, but also bad habits form because you do things and then you get rewarded for doing the wrong things, and then you start telling yourself that, you know what, I can continue doing this, and you go down that path. Would macroeconomics and fundamentals help me hold trades for longer? Yeah, I think, do you know what? I think definitely having a good understanding about your news, like for example, CPI and things like this, and how they react is an extremely good benefit. For example, if you're in a trade, you're running 4%, CPI is coming out, and you know this could potentially spike 100 pips either way. And if it spikes against you, you'd lose all your profit, take the profit and walk away. You know, it's not worth risking it. But if you're like consistent, it's a different situation. But I'm pretty sure that a lot of people are not at that level of consistency they want to be at. So it's better for you to walk away with some profit than opening yourself up to the risk of not knowing. If you know you're completely on top of your news, you wouldn't even ask that question, because, you know, you'd be like, well, yeah, cool, I've got a plan. I know what I'm going to do statistically. Always take the profit. If you're coming into NFP, CPI, despite however you feel about it or whatever the market looks like, doesn't matter. Just take the profit, walk away. Or you can take the profit and leave a small portion of the trade open. Just, you know, that's always an option as well. Partial close. I just think that, you know, a lot of people lose their funding and compromise their psychology because of news, and they put too much weight on it. When you're back testing, you're looking at data. We don't look at news. You know, we don't know during, you know, all these dips and stuff you see during the sessions as well. A lot of them are news related. News comes out and it commits right at the right time. You know, like if I look here, you know, you've got this little bit of liquidity here. Price came there. You know, it came up kind of with a 1, 2, 3, tapped into the liquidity. That was roughly around about your sort of, I don't know what time that would have been, but it looks midday, you know, probably about New York session open. Yeah, it was. So 1 o'clock, committed. I'm almost certain there was probably some news there as well. So at the end of the day, it's not really about the news. It's about understanding structure and how you can use this in your benefit. You know, something like this could be CPI as an example, right? I wouldn't want to trade that, because even if I was right, you know, okay, sure, you'd be like, yeah, big profit, but at what cost? You know, if I was wrong, it would be huge slippage. So that's why I kind of avoid those types of news, like the small news, which could be something like, you know, not unemployment rate, but, you know, RBA meetings, or, you know, something GDP. I know that I'm not going to get huge, crazy, impulsive behavior like this, so I don't need to worry so much about those particular newses. There's just certain ones you want to avoid: CPI, NFP, you know, and so forth. If you're trading crude oil inventories, you just want to be conscious of them and accept the risk. Why was there a pretty big gap on the market opening last week? So Donald Trump put some tariffs, well, he put NASA tariffs in place with China, and there was a lot of liquidity being moved, especially with gold. So I don't know if a lot of you follow gold, but if you look at gold as well, a lot of liquidity was moved. They moved money out of crypto as well. Again, and I'm just saying this, really and truly, the Trump situation and stuff had nothing to really control a lot. It just gave a catalyst in the market for people to take control. You know, like over here, tell me what about this looks like it was news driven. You know, we can see if we break down the price action, you can see like, okay, that came in, spiked, left a gap, came back down, retested this area, came up, correction on the high there. Then we broke through this, we stalled, we pushed above, created a large continuation above that high. We then pushed higher, and now we're creating something larger within this, and it's getting more complex because we're further in the run. Do you see what I mean? Like when you really look at price action, you can really break it down. I'll look at crypto quickly, BTC, because I know a lot of people on my DMs on Instagram were messaging me about this, like, oh no, it's sold off. Are we going to see a complete sell-off? I'll be honest with you, look at this, right? That's a huge correction in itself. That's one big correction. So that sell-off from there to there, which used the news that Trump had as a catalyst, you kind of then have to ask yourself, really, is this all kind of manipulated already for price to do what it needs to do, but they're just using the news to create fear? So when you use the news to create fear, people start asking questions like that, like, oh, what, you know, what's happening in the world right now to cause the market to sell off? Or they're holding S&P 500 ETFs, for example. So if I show you the S&P 500 again, this is how the market ended. right? You see that drop there, it's not even huge. If I go to the weekly, you know, what the hell is that? That's nothing, it's just a little dip. But this is where fear is created. Everyone at this point here is like, okay, I'm taking my money out. So then they got involved down here, right? So I bought here actually, which is quite interesting. It's around about 28% gain right now on the ETF investment. But again, people who bought in these areas and whatnot, and they see that huge dip there, for them, they're thinking, oh my God, it's dropped like 2-3% or 1% on their portfolio. And they're thinking, okay, I'm going to get out because I'm concerned I'm going to lose all that profit. It's that level of FOMO that's being created in these areas. And then bigger players are buying up what they're selling. So the truth behold is this is a very, very cheap investment, because it's, you know, in today's value, it's not a lot. But for a lot of people, when they see these little small dips, they're too zoomed in. They don't go on these higher time frames and zoom out like I just did. What they do is they go on the 15-minute. And then their charts, when they open it, because platforms do this shit, is they see it like that. That's all they see. They see this. And they're like, oh my God, have you seen what happened with the S&P, man? Oh, do you think it's the end of the American market? Oh my gosh, look at that. You know, when you look at it like this, it kind of makes you feel like, oh my God, what the hell's going on? But when you zoom out and you go back to the high time frame, you're kind of like, well, that's nothing. That's a nothing move. But then when you understand it from a technical point, because you've studied it, you're then like, well, you know, there was a bit of liquidity there. This was all pretty much corrective. A sell-off is normal. It's healthy for the market, because it shows that even though that people have taken profit, people are willing to buy it back up. So it just shows that the consumer is in control of just pushing price higher. So whenever you see stuff like that, you can actually make money off understanding things like this. If you trade the S&P, you can take value. You can take advantage of areas like that. Maybe once in a while you'll be wrong, but a lot of the time you'll be right. Even if this came back down, did this, you know, I wouldn't even be worried even if it came down further. Eventually it will recover. It always does. It's historically been proven. Can you give us, okay, so funny facts. Can you give us some repeatable confluences for lower risk trades? Absolutely. So, first of all, repeatable trades, it comes from the mindset as well, okay? You have to train yourself. There's something called a reticular activating system. Like if you tell yourself, red car, red car, red car, and you go outside and you just think about red cars, you're going to notice red cars more often. They've always been there, but you're going to start noticing them more often. Your reticular activating system is a part of the brain that is then triggered, so that every time a red car comes in, your awareness pulls you in to say there's a red car. It's the same thing with trading. So when you're talking about low risk trades, it's less about, I mean, there's many layers to it, okay? There's many, many layers to it. And the more you train yourself to understand them, kind of like eating soup, for example, there's a process to it, right? You take the soup, you put it on the table, it's hot, so it's already on a plate. You have to wait for it to cool down. You get your spoon. You have to know how to use the spoon. You need to know how to blow onto the soup water to make it cool. Then you need to sip it slowly to test it so you don't burn your tongue. And then when it's good, you swallow it, and you know, you repeat the process. So forth, right? It's the same thing with your trades. So you've got a process to it. For example, and this is one that, you know, is widely known from people who pretty much trade this particular type of way. You could wait for, let's say, you've got price comes up and creates a value area high, okay? It then sells off and comes down. Then it comes back up and it leaves a gap. Key point, the gap. It then comes down again and it taps into the low, creates two bottoms. Now you've got two highs, technically two highs, two lows, but one high has a gap. You then know that there's a high probability it will come in and fill that gap at some point. At that point there, you can take advantage of the two bottoms. And then you've basically got a trade in itself where you can take advantage of the larger flag as well. There's another one here as well, where let's say you've got the value area high, price came up, tapped into the value area high, and then it pushed away. It then invalidates the idea of this then developing into this. For example, it breaks that and creates continuation. goes, right? Why is that better? Because it's basically using all of the liquidity there to then take this and go. So keeping something like that is a great little gem as well. But I'm showing you all of these things, and I don't expect you to go off and try trade them all. You need to just find one thing and be really good at it. I've said this quite a few times, like Bruce Lee's quote, you know, I don't fear the man who practiced 1,000 kicks. I fear the man who's practiced one kick 1,000 times. What's your one kick? Your one kick might be price taps into the value area. It pushes away significantly on multiple time frames. I get daily confirmation. I get 4-hour confirmation. I get 1-hour momentum confirmation. I then clear significant lows within that. And then I wait for my continuations. Another one might be I wait for clear structures to tap into value areas with structure, and then I take advantage of that once I've got this in place. But I don't take the trade in there. I wait for us to clear maybe 50%, and then anything below that I look to take advantage of. You know, you can set your criteria, but really and truly, like, you have to come to a realization that you're in control of what type of trade you perceive to be low risk. What would be high risk is you saying, I only take it below 50% here, but then you decide to take a trade within above 50%. And then you're like, okay, hang on a second. Why did I do that? Well, that's high risk, because the high risk part of it is you weren't able to follow your trading plan. You weren't able to follow your rules. And you've seen that play out so many times now because your reticular activating system is trained on it, that you started wanting to adjust things through intuition, which is not necessarily the worst thing, but at the end of the day, it doesn't always necessarily make you money. So it's one of them ones where you can keep it simple and just consistently make money this way. You got clear 1, 2, 3. It came from momentum. Let's say it came from all the way up here. It came down, created this, and then you basically got a simple 1, 2, 3, and you can just stick with that. And then you've got simple criteria over here. I've got structure, then I've got my candle confirmation, which is maybe a pin bar or even a retrace candle. And that's it. That's all I'm looking for. And I'm looking for those trades every week. And if I only look for those trades, you'll make money consistently. What advice do you give to a struggling trader? It depends what you're struggling with, to be honest. You know, we all struggle with different things. I would say most of all, just consistently work on your mindset. And when I say that, I don't mean constantly go read books and stuff. I mean, take your time with what you're doing, but make sure that you're protecting your psychology. You're putting in a little bit every day, like 1%. You're working towards having a better all-round way of thinking. You're not forcing yourself to be someone you're not. Like, find a sustainable way for you to trade. Find a sustainable way for you to have your day-to-day life, something that fits with the way you want to trade. It has to push you to be a little bit uncomfortable as well, because that's very important. That if it's too comfortable, it's too easy, and if it's too easy and you're not seeing results, that's probably why. But it has to be something like, and I'll tell you mine, I wake up in the morning, I do my visualization, then I go to the bathroom, I get refreshed, have a shower, then I get ready, then I prepare my day, I clear my trading environment, then I set up my charts, do my morning forecast, then I basically get myself prepared for London session, take my dogs for a walk and whatnot, and then after that come back. After the first 3 hours for London session, then I'll start taking a bit of time to do some meditation and a review over my London session. Then after I finish that, I'll take a small break, and then I will then do my evening forecast. When I finished my evening forecast, that's preparing me the same way I do my morning forecast, I do my evening one, and then I know what I'm looking for the afternoon, New York session open. And then after a few hours after the New York session open, I'll do the same thing. I'll then review my New York session and then basically plan for the next day. And you can see how simple it is, because you're not going to take a trade every day. So if I do my review and, for example, London session comes around and there's nothing there, then I know that, okay, cool, I might likely be waiting for a New York session. Then doesn't mean I won't do anything for the rest of the day. I'll just be like, okay, well, I've got the morning free now, so I'll still crack on and do everything I need to do, but I know that I don't need to do anything trading related, because then I'm just forcing something. There's nothing 10 out of 10 that meets my trading plan. Yeah, sure, I might miss something, but then I can learn from the missed trade. It's just more important for you to take that time to realize that There's times where you have to be by the chart where you don't need to be by the chart. So that morning version of you is setting you up for the day. That morning version of you is the person that is going to make sure that you're mentally prepared when you're exhausted later. That planning and preparation is what's going to make you money. So you have to, yeah, definitely put in that work and build that nice processed routine. You know, make everything simple. Like, I save myself a lot of time because, for example, when I prepare my charts on the weekend, I start preparing it on the Friday, then I do a little bit on the Saturday, and then on the Sunday I finalize it. And it doesn't take me a huge amount of time. Every day, for example, let's say on a Friday on a Sunday I've prepared for my Monday. On a Monday evening, I'll prepare for my Tuesday, and then the Tuesday evening I'll prepare for the next day. And you see how it just spirals. So when I say prepare, I mean I will look over the charts on my watch list, because I've done that on a Sunday, and I'll say, okay, likelihood, London session, we might potentially see the completion of this continuation. So London session open, I want to be looking to take a entry. So then I know pre-London, I'm going to be mentally prepared, and I'm going to be basically planned ahead from the day before. I know that, for example, I'm looking at CJ. I'll be like, okay, cool. Monday evening, I'm looking at CJ. I'm going to be waiting for Asian session to complete the continuation. So roughly around about pre-London 1 or 2 hours, or London Open, the entry is going to shape up. And then I know for a fact that's the one that I'm going to be really looking for. And I might have the same thing happening for 2 other pairs on my watch list. And then that's how I keep myself well prepared. And then I do the same thing after I finish my London session. I do the same thing for New York session. I finish New York session, I do an earlier one for the next day, and then the next day morning I then continue where I left off. And I'm always in synchronization, and that's a very important factor. Silver got it on this week, possibly a short from the monthly top. You know what, I do like silver, but people are pretty mad about silver right now. Like, they're really trying to buy this because silver is considered very, very undervalued. So people are anticipating silver to really pump to the upside. I think it's too soon to short silver, man. You want to be seeing some crazy price action in the market, I'll be honest with you. Just check this out. Look how price has just moved. It's aggressive. This is the 4 hour. I'll go to the daily. Look at that, right? We can't be looking to call tops in these areas. If you tried to call the top here, you would have been wrong. You would have been wrong. Any of these areas, you'd be wrong calling the top. The odds are, when you know price is gonna turn around, you're gonna see something like that in the market. You know, you're gonna see price just really start doing this. And then that's when, you know, silver's just completely trash. But the odds are it's probably not gonna happen, man. If you look at this historically, silver's always had value. Correction, push, decision making of the future price came up, accumulation, bigger players stepping in, and then boom, silver's just going. You know, silver will eventually find a base and we'll have another corrective period for some time. But then don't be surprised if we see this again in the future. You know, what we might see is silver does something like this at some point. Doesn't have to do it here. Could do it up here, could do it up here. Most likely could even come back down here, do something like that, and eventually just continue. So if you're looking at this trade for an intraday trade, sure. You know, I don't see anything wrong with taking an intraday trade. I'm just more favorable for a long than a short. And clear reason is just look at the market direction. Get involved with the trend, man, because you never know when you're getting involved with something that's moving like this. If this then comes down, creates a base, and then comes up and creates another base, and then that's the base, and it does that, and you get involved here. What if it does continue moving within this overall trend? Would you rather get positioned on the short, or would you rather get positioned on the long? And I think getting positioned on the long is way better, because had you got involved here, 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 even here, when did it ever come back and tag you out? You know, so in terms of overall price protection, the long is much nicer. That's my opinion on it. Cephii, I'm also looking to sell it. What are you guys looking at to sell? Let me see. Let me go down to the 1 hour. Yeah, no, man. I think, again, this is traps, man. If you see this and you're kind of like sell it into here, I see it, but at the same time, you don't know how this is going to develop.
right? This could develop in so many different ways. This can even just continue pushing. Something could just happen and this pushes up higher and then it develops up here, right? So you're probably banking on something like that or even into those areas. Price comes down, but the odds are it's not going to come down the way you want it to come down. It's not going to come down big impulsive candle. So that's something you have to also consider. Price might just potentially be a bit more corrective and be something like this. So then you have to ask yourself, like, you're going to sit in that trade for, you know, maybe a week, 2 weeks, and it's going to be up and down, up and down. How are you going to manage that? Those are things that you kind of need to consider when you are positioning yourself. If it did come down like that and it was aggressive and then it closed like that on the daily, and then you had continuation like this, sure, I wouldn't say that's a terrible trade, but then at least at that point, you've got that volume to play with. Right now, you don't have any of that. Right now, you've actually got a lot against you because it's just squeezing. Yeah, so in real life, my sis said ew. Know what that means? The question I asked is not last week, Friday, Trump tariff war, but last week, Sunday, on the Monday weekly opening, take a look at AJ. We were on the lookout for the longs when price opened. Let's have a little look. Right, I see, okay. So Friday the 3rd, and then we jumped up. So let me read that one time. The question I ask is not last week, Friday, Trump tariff, but last week, Sunday to Monday, weekly open. Take a look at AJ and look out for the longs for market opened. Yeah, I mean, do you know what? This is well here. So, you know, we did have that low there. We came into it, which is interesting. You know, we came into this area here and then we just opened up here. The problem with this is this could have just easily came back down and then come back up. So it's a tricky one. I think, you know, I think it's easier to see and worry about after, but systematically, you know, what you would usually just want to do is keep it so simple. You know, you've got this as your continuation. You either wait for something here to go long or you don't take it. If you get too zoomed in, you know, you're asking for a bit of trouble, but this sort of trade here, I don't think there's anything extremely wrong with that, but it is high risk, man. That's the only crap thing about it. But you can see by this point here, with all of that push, it's just clearly giving you a signal that we're not going to fill this gap right now. We're going to come back. So that was that. I mean, this short here, fully anticipated. You know, if you were looking at the JP225 for this short here, you could have taken full advantage of that on the yen pairs because the JP225 started moving way before and the JP225 wanted to fill its gap. So with the yen pairs, the short was definitely something you could take advantage of. This was looking like a continuation to continue within this corrective move. The gap, something you couldn't control, nothing you could do about it. After that gap was made, we did want to see continuation. That was a continuation, which is okay, but something a bit more weighted, man, that would have been exactly what we needed, but we didn't get it the way that we needed it. And then it just kind of continued, made its way higher, and then it went lower. So yeah, do you know what? It's one of them ones that I wouldn't overthink it. And I wouldn't feel like it's a crazy mistrade because just so many trades, man, like hundreds and thousands of trades that go on every year. So that in comparison to most of the trades I've seen this year is nothing. And I wouldn't even worry about that gap at all in any way. But yeah, good you're looking at longs. It's just when you've got a gap like that, odds are sometimes it comes here and then it just sells off. And the same way it came up fast, it comes down fast, then taps into the low and then makes its way back up. That's why I would kind of avoided that myself. And cleared it. Okay, GBP CAD, Aussie CAD. All right, you sent me OS, let's see, GC. GC, what we're looking at here. Let's go to the daily. So yeah, nice. I like this. So what we have over here is we've tapped into that area of value. We've kind of squeezed into it, which is nice as well. What I don't like is that massive sort of wick there on the daily. If I go to the 4 hour, we tapped into this, a little bit of liquidity. We left a gap to that, but again, we've tapped into this. We then pushed up and we're there. We didn't really clear the high as well, actually. I see this here where we took out the high here, but then we actually left a gap again to that one, borderline. It's not that problematic, actually. I think you would want to draw your line in the sand here, and you want to wait for that. You want to wait for the sell. You don't want to just jump into anything on this, actually, because this could get messy. It could just do this. It could just completely fuck you up on that trade. So I would say wait for this. Wait for this to come off, sell off, come back into these areas, right, and take that trade. That is the trade you want to take, because you can manage it easily into that low and then further down. So a trade like that would probably make you some money, man. Probably make you some good money, and it's low risk. Why is it low risk? Because it's failed to continue within that. It's manageable into the next point. This is a perfect one for building the confluences. You can easily manage it to the low of the flag, let's say. Let's say I got even 27 pips. You probably go tighter, to be honest, but let's say you go about 20 pips into the low of that flag. You've got about 2.6 to the bottom of this level here. You've got about 5.6, and then to the low over there, you've got roughly around about 15 to 1. So again, this is something which I would 100% want to go for, because if we break it down from the daily, what have we done? We've tapped into the daily value area. We've had momentum. We've come down. We've then shown that price is failing to sell off with that wick. But then what's happened is we've then filled the wick. Then after we filled the wick, we started closing below it. We started creating continuation. Where is that going to go? Well, it's going to seek liquidity from the next point. Can I manage it into it? Yeah, I can, with at least a 6 to 1. And then if it breaks through that, which it's basically below 50% of this overall structure, and that's corrective on the way up, likelihood is probably going to come back down to those areas there. I can manage for about 13 to 1. So you can see how that's a solid trade in itself. So yeah, definitely thank you for bringing that one up, because in itself, that's a nice trade. Aussie CAD, let me quickly have a look at that one. I think Aussie CAD probably be quite similar. Let's have a little look. Interesting. So Aussie CAD, on the other hand, what we can see here is we've tapped into liquidity there. We're creating larger continuation. There's a gap to the high over there as well, what we can see. So if we look at it on the 4 hour, yeah, this is a tricky one, because like you've got your highs, 2 highs, you came up correctively, you squeezed, failed to continue over here, which is fine because it's larger flag, sold off, tapped into liquidity there, rejected, pushed up, and now it's just kind of squeezing. I would be conscious with careful with this one for sure, because even though we've got these bottoms in place and there's a little bit of liquidity there, which doesn't really necessarily need to be tapped into, we do want to see something a bit more confirmed, because this can still develop and get a bit more aggressive against us. Reason being is, even though this point was tapped into, that was quite impulsive, it's now retraced around about 50%. We could see this kind of come back down and then create something like that. And then we see the same thing we just saw, where this becomes failed continuation, that becomes continuation, and we sell. So we are in that type of area, and I say that because if I go to the 4 hour, what did we have? Well, even though we have the gap up here, which is fine, we tapped into the liquidity here, then we created a mini double top. So bear that in mind, that we're not necessarily creating continuation to move higher. That could be a mini double top, creating the high for it now to sell off and come back down. So it's one of those ones where you could easily get trapped into seeing the continuation. The difference between this one and having this trade positioned elsewhere was if, for example, let's say you had that and it came down, and then you had the mini double top here, right? The reason why this would be different is because the liquidity is not sitting directly to the side of this, right? It's sitting just below it. But right now what we're seeing is it's kind of through it, right? And it's showing that it's created a base, but it's not really fully confirmed yet. The only way we're going to see this confirmed is once price is actually really back up here. If I just measure this on, this is a great tool to have as well. If you measure this overall flag, 50% is about there. So we're still pretty much in the sells right now. We haven't really seen this show us commitment to the upside just yet. The high risk trades would have been in these regions here. Anything above the 50%, above the retest of that, it would be much better. Right now, this can still just develop into a bit more for retest, where it sold off sharp, people started getting out of the entries, it then comes in, retests all of that, and then it sells off from here. And that's definitely a strong possibility. The way to mitigate that is you've got this as your line in the sand, price comes back up here, it's clear as day, and you can take advantage of the continuation here and play it higher. I just think that, yeah, it's one of them ones where I would look for the short. I would wait for that to just sell off. And then when it's down here, I've got clear selling momentum to the downside. Such a massive play as well in place. You know, look at that. If we start rejecting from that area and that ends up being the double top, and we've got all of that room for it to just really just move. So that's a pretty interesting trade in itself. Aussie New Zealand. Let's have a little look at that. Yeah, Aussie New Zealand, man, look at that. So if I just look at it here straight away, we have a high here. It's clearly moving to that direction, and we've got accumulation. So keeping that in mind, obviously we saw Aussie New Zealand with the Aussie CAD just now with the potential long continuation. Something like this would then kind of confirm that trade a little bit more and say, do you know what, actually there's a strong possibility that that could be a long continuation. I'm not the biggest fan in the world, but right now what I can see is we had small continuation, we've left a gap, we then came up, we took out the high here, we've still got a gap to the higher time frame, we came down, we took out the gap, we filled the liquidity there, and now we're coming up. So then on the hourly, I'd look for continuation. Great thing is, this is beautiful, right? What we had here is we failed to create more continuation here. So that all failed. The trade thesis for shorts was then ruined, and then we had continuation right there on the hourly as well, which is pretty decent. So there was a trade actually already shaping up in here. I think, and I'm just going to clean that off quickly, I think what we might tend to see is a possibility that then this comes back down, taps into that area, and it goes. If you get something like that, I wouldn't want to be the person to hesitate on something like that. I would look for clear retrace. This is 15 minutes, so on the hourly, how would that look? Probably a little bit like this. Not the cleanest, because you know that can still develop into something larger, but if I did get clear confirmation on that, there is an internal 1, 2, 3 on it. It's your first flag, so it's high probability. I could probably get in with, you know, even if I put this on the wick of that candle there, I could still get in with roughly around about 15 pips. So then to the top of this structure, I got about 1.2. It's manageable to break even if I wanted it. Then I've got to the high over there, I've got roughly around about 5 to 1. Yeah, I'm definitely happy with a trade like that, man. That's not bad. I would be much preferred for a more developed flag. So if this came up and then, you know, did that, that would be a much more favorable scenario, but I just don't think that that's going to be the play. I think this is going to be more for a lower time frame, 15-minute, bit of a trick in there. You know, it's had this bit of a squeeze. It then comes down correctively, makes its way back into these areas here, taps into the base. It then becomes something like this, and then it goes, and then that's just your expanding first flag. Seen things like that quite a lot, and I think that's definitely a high possibility. So keep that in mind. And then last one on that list was Aussie Swiss. Aussie Swiss. Oh, wow. Yeah, I like that a lot as well. So yeah, decent. So what did we have here? We had the low. We also had this larger correction. We sold off aggressively. We actually missed it as well. We missed the low, which is something to keep in mind. But we did basically borderline tap into the liquidity there. If I go to the daily, it's not really your best. Like, so corrective, came in, correction, pushed down, larger correction, came in, left a gap. Yeah, man, this might be a clue that we're looking at a bit of a more complex bit of price action right now on Aussie Swiss. Definitely one to definitely keep attention to and see how it forms, but I'd be conscious with how messy it's been. Like, you've had your 1, 2, 3 opportunity to sell, failed, correctively came, left a gap to the high, sold off aggressively, left a gap to the low, retraced, retesting now. There's nothing about this that jumps out and says this is clean, great price action, something that I can repeatedly capitalize on. Check this bit of price action out. You got this little bit of liquidity, came in over here. It correctively came back, retested that area. It then sold off, created failed continuation, created your correction there, and then sold off. That's really nice price action when you look at it like that, right? That's great price action. But when you look at something like this, you know, what do you have here? Well, it sold off there, then you retested this area here. We had this little bit of liquidity above, it didn't really reach. We then evolve this and we say like, okay, we have that. What do we have there? Came up, came down, failed to continue, came up correctively, left a gap, sold off, came, left a gap down there, came up. There's nothing clean about that in comparison to something like this. Even though that's messy, there's still something you could take advantage of there with the arguable head and shoulders in place. I'm definitely seeing a different chart on Silverman, Silver FXCM data. Yeah, that is a one that always pops up when you got the difference. So I'm looking at it on capital.com here. If I put silver in the chart, let's have a little look. Silver. We're looking at Oanda. Let's go on Oanda. Right. So yeah, same situation, man. It's not much difference. There's not a huge amount of difference. You can just see the whole psychology of what I was saying. I know in the moment you could see something like this, and you've got a pin bar. I'm sorry, you've got like a doji there. I mean, it's risky, man. It's very risky because look, you're basically banking a lot on just some candle. And if I wanted to trap you out and I was somebody who had, you know, tens of billions and I wanted to take some amateurs' money, I would do shit like that. And I'll get people caught up in that. The odds are, I want to convince people that there's an end to this because I want to keep buying this. I've got buys in here, so forth. I've been buying this like crazy, right? I want to convince people now to short because I need to build more liquidity for this to go higher. How can I trap them in the market? Well, I can build traps on the way up, right? I'm not seeing crazy exhaustion here. I'm seeing traps in the market. Look, every time it sells off, it gets bought back up. Sells off, gets bought back up. See the same thing, probably sells off a little bit, it gets bought back up. Be careful with silver, man, definitely. Can we have a look at your weekly watch? Yeah, for sure. I mean, my weekly watch, I'm not actually trading crazy live this week. You can see it's quite big watch list I've got at the moment, actually. So I'll show you. So I'm basically waiting for quite a few pairs. I'm looking at your New Zealand CAD here, where I want to see if this retraces higher and gives me some sort of continuation. But, you know, New Zealand CAD's not really the one this week anyway. I'm looking at Aussie CAD for a failed continuation to the downside. I'm looking at Aussie Yen to see how it responds to this bit of liquidity here. I want to see if we do sell off and we get continuation here to sell. We could be in for a pretty decent sell to basically recover that sort of corrective move higher. Likewise, if this starts to push higher, then I'll just wait patiently to evaluate it. Aussie US dollar. I did want to see this a little bit closer to see if this was a squeeze and then it evolved into something, but right now it's not really showing me the sort of price action I want to see. I think it's just genuinely a part of very crappy price action. So it's not really my go-to either, but I'm just monitoring it to see if these Aussie pairs do sell off this week. How can I take advantage of it? But also, if this does somehow make its way into this area here and it sells off, I want to see if we come back up and then we start getting continuation. Can I take advantage of that? That's probably not going to happen anytime soon. That's probably going to be in a couple months from now because this is on the daily. But taking advantage of that overall picture, if you go to the 4 hour, you can then see that this is coming in to retest this. I want to see if this comes in here, stalls, and then rejects, gives us continuation, and we can sell into those areas. That's what I'm really looking at, is seeing how I can take advantage of the move lower. CAD yen. CAD yen is, again, it's one where, you know, we tapped into this bit of liquidity. We have this high here and so forth. But because we tapped in it here, I just want to see that we sell off, we recover that, and we're filling this gap. So there could be the potential for a sell-off continuation within those areas for us to eventually come lower and fill the gap. A lot of these trades are kind of preparing me for the weeks ahead, because I've got guests coming in at the end of this week. So I know I'm not going to be as active as I want to be, because I don't want to get into the full swing of routine. And then after I'm in the full swing of routine, I'll come out of routine and go back into it. So I just want to stay well synced really well with the market, so I can take advantage of it. Swiss yen, similar situation, just looking to fill the gap on that. See how that forms. If that breaks lower, gives us continuation below that little hook point there. I'm all for shorts. Euro GBP, a bit messy to be honest. If I go to the 4 hour, you can see that, you know, we've tapped into that area. There's tiny little near miss, but we've correctively pushed away. So I want to know if this is going to continue higher. Will we get a clear continuation in those areas? Or if we just sell off aggressively, are we going to retest one of those areas to go long? We do have the aspect of a 1, 2, 3 here. Keeping that in mind, if we sell off and we get continuation in those areas, that will gear me up for a pretty decent trade. EJ. Let's go on EJ. EJ, same situation with the gap fill. I think, you know, it could just be a slow bleed right now on a lot of these yen pairs where they don't give you anything and then next thing you know, boom, crazy impulsive drop off. So that's something as well that I'm going to be just kind of keeping on the sidelines. EU was one that I basically had eyes on the short here. I didn't take advantage of anything there because of it not really meeting what I wanted, but this developing into a larger flag to continue more further to the downside would be great. Zooming out, you know, we can see that this is probably going to move higher as well at some point. So I am looking at I'm looking at shorts before longs. I do want to see if that develops into a larger flag to potentially go short, or a failed continuation to the downside to then potentially get a long to the upside. So pretty neutral on that one. And then I've got GBP CAD waiting for the short on this one. Again, this one could take some time to develop. I need to see some strong momentum come in the market. GBP Swiss, similar to your Aussie Swiss, but I thought this one was a bit nicer. We've got the massive gap to the low down here. I want to see if this comes back into those areas there. And then when it retests those areas, do we get a brilliant sequence to the downside here? Just aggressive sell-off. That's what I'm looking for. And then GBP yen. GBP yen's a very interesting one. So I was talking about studying sessions earlier on the call, right? So basically, you can see here Asian session, Asia session over here, London session, and I wanted to kind of point out, like, if I go to the hourly and I just show you this a bit more clearer, you might learn something very valuable here. So where's the sessions? It wasn't that one. That's the one. Check this out. So this is New York session. So sorry, not New York session, Asia session, where you can see the continuation formed. During Sydney session, we had the retrace, and then Tokyo session, we had the sell-off, reduced risk entry. There was room to take a refined entry on this, but I didn't want to take a refined entry because I wanted to take it in respect of session opens, closes, and so forth. So you can see Asia session, you had the candle open, the entry came in, that would have resulted in a 5.8% win. Why? Because we essentially had the low to these sides over here that we were trading into to fill those gaps. So we would have managed it aggressively as we reach those. So that was that trade there, 5.8. Then we had this one here, Asian session again. You had Tokyo session open. The candle confirmed exact same way we had it there. Did the same thing again, and we sold off. That would have been 5%. I'll remove this one. Then we've got over here another trade. This was London session actually. So we had London session open, candle confirmation. We corrected during London, New York, and Asian session, and then we basically got the confirmation and sold off. So again, pretty interesting price action in itself there. I definitely think that a lot of the time people don't take advantage of this. They don't realize, they think, okay, I'm going to trade during London session. There's 5-6 hours in London session, and then what happens is they just don't make the money. So something to just bear in mind. You know, by keeping sessions specific, you can make a lot more money. What we've got here, so please check NAS 100. Let's have a little look at NAS 100. So indices, US 100. Go to the 4 hour. Yeah, NAS 100, definitely a recovery play right now. As I was saying with the S&P at the beginning of the call, you know, we're seeing that here where it's tapped into the liquidity point there. We've pushed up, now we're creating sort of recovery sort of territory. So I would be on the conscious side of two things. There's a gap here as well, right? Either this just kind of gets corrective, comebacks, retest those areas, and then just sells off and comes back into those areas. I don't think that's really the gameplay. I think what's going to happen is we're going to see some level for recovery. So you want to be more on the side of patient, but you want to be waiting for something clear. Remember what you've got here, same as US 100, US 500. It's basically leading this particular instrument. You've got the low there, and you've tapped into that. So the liquidity's been met. We're continuing within the corrective wave. This can just high probability wise just continue squeezing to the upside. And next thing you know, you're at all-time highs. I've seen it so many times, you've probably seen it too. Just keep that in mind. Yeah, definitely. So I am on IG. If you go onto my, what's it called? Oh, here it is. This is the IG page. Yeah. If you search it up as KunalFFX, it will come up. So if you just search that, you'll find the IG page. And yeah, so yeah, that was basically it. I mean, do you guys have any more questions about anything in general, anything you're struggling with, anything that you guys need help with trading wise, something that you've kind of gone through and you want to share? Definitely here. Answer that. Yeah, definitely Pro Sword. Take care. Yeah, sweet. Cool. Well, yeah, that's it. Don't think I've got much else to kind of throw in there. I could definitely play a piano song before I end this video. So, hey, what's going on? Ryan Sly, let's play. You didn't check the month time frame on silver. Yeah, I'll be honest with you, with silver, it's not worth it, man. It's just in high value territory right now. If you're taking a trade on silver, it's high risk, man. The shorts are just so high risk because it's just pushing higher and higher and higher. It could short term move to the downside for a little bit, but you don't want one big spike in candle to push it higher again. That's the territory you're playing with, because right now, with fears of war, tariffs and all of this stuff, people start removing their money from indices and economies and they start putting them in commodities. So what you tend to see is if the indices start to recover, you start to see certain commodities like gold and silver go short term. But then what you then tend to see is that, you know, Israel comes out and does some crazy stuff, and then all of a sudden people are then taking their money out of the markets, moving it back in gold, and then appreciating the price of silver. and this seems to be a very strong commonality that we see in the market, is that when in fear, they put money in commodities, waiting on price to retrace to 4057. Let's have a little look at that. So, watch list, currencies, commodities, silver. Yeah, man, it's an ask, man, because even the 4 hour hasn't even really given me a strong confirmation. The weekly, the daily, looks like London high liquidity sweep has taken place. Hopefully we get a retrace to enter longs. Yeah, I mean, you know, I'm definitely for a trade idea for longs, but I would wait for some structure. I think short-term moves, yeah, man, if you're going in for like a sort of 5 minute sort of trade or something, fair enough. I just think that it's a tricky one, man. Like, you don't want to just be jumping into any ordinary trade. I want to be looking for some high probability, proper money making trades, you know. I'm not looking to kind of just scalp into a short-term trade. I know that it works for some people, but in terms of sustainability, man, I want to make some real wealth, you know. I want to do it with some systematical processes. I don't want to mess about with a quick trade here and there. Let's go on. I'll show silver. I'll share it out. Yeah, like silver here, I can see like you've got this sort of base here. You've then broken the low. You're now coming back up. Want to take a trade there. The reason why I don't like that, not that it's not good. It'll probably make money, but when I go to the 1 hour or the 4 hour, where am I, man? I'm like, I'm in this. And, you know, we've had people today say, you know, I want to go short, I want to go long, I want to go short. It's very up and down right now. It's not clear. Like, if price, and I know that, Zephyr, you're probably looking at something like this, right? Where you want to see price come back down into those areas, take advantage of that sequence. I think there's nothing wrong with that, man. If that starts shaping up and price just, you know, dips, gives you continuation here, and then you get that and you can manage it into that low, and then next thing you know, you can wait to see, okay, is that going to then develop into this, and then that becomes the continuation, fair enough. Or if that then develops and creates more continuation, and we can trade it into that low, and then that becomes the point where, you know, whatever that becomes, they expand it to continue higher, fair enough. I like that, and I also like this, right? This whole point here. But if I had to pick between those trades, I would wait, personally, for either this trade here, I'll wait for that trade. Wouldn't take that one because, you know, of what I said, how that could develop. And then I would wait for it to come here. And then if it came there, I'd wait to see how that responds. And then if it came up and did this, and then came up and did it again, I could then take advantage of the buys. And that's how I would want to take advantage of the buys, like that. So I would personally be in favor of that, because then that's kind of like, okay, fine, there were some short-term plays in there, but the real-term, longer, higher time frame buys were in here. And those trades could turn into like 10, 15%. And those are the trades I would really want to wait for. So that's basically what I'm looking at on silver. You can see how it's basically still going to be respecting that corrective channel as well. What did you guys say? So London session high, yep. You swing trade or day trade? I think the correct terminology is position trading, which is not so much. So it's basically like a mixture between swing trading, position trading, long-term, short-term, multi-time frame analysis. How it's really described is that I wait for particular structures to form, and then I take advantage of them with extreme precision, so that then I can get positioned correctly with the overall higher time frame move. As a day trader, you're basically taking the trade, you know, like this on the daily, which is essentially swing trading, right? You're basically selling, buying, selling, buying, selling, buying. And then within that, you might have a day trade here and there, right? What are you scaling? as a swing trader, it's kind of the same thing on a lower time frame. You're getting in the sell, and then you're getting out, you're getting in the buy, and then you're getting in the sell, you're getting in the buy. So, you know, it depends on how you want to look at it. I'm more of somebody who just gets myself positioned on high probability trade setups when and where they shape up. So I would say that's my base, and then that's my low risk trade right there. And then that's the trade I'm going to be looking at. So you could call it day trading because I might take one trade in a day, but then sometimes you call it swing trading because then I might take the short here, like Zephyr, take the short, then I get in the long there, and that might be within the case of a day. So then that day trade becomes a swing trade. Thanks. What is your actual start, if you don't mind me asking? What do you mean by actual, strategy? Okay. So I've got a lot of videos on my YouTube channel actually, but the strategy is actually simple. It's a Falcon trading system, which basically just looks at it from a high time frame. I'll clean this off because right now I've been studying something with that indicator. So what I've got here is I've got the DXY on the daily. I'll be then looking at it on either weekly or daily, but let's say I'll mark on a weekly value area, right? Like this one here. I'll mark on this weekly value area here. And then at that point that I've established, that's where the liquidity is sitting. I'll then evaluate with structure, how did price get there? So then I'll draw on the structure, and then I could see we got the 1, 2, 3. We tapped into the liquidity there as well. And then I start then evaluating sequence. So once I've got sequence in mind, I'm still looking at positioning and how do I get positioned in that. So then I look at the structures within it, and I see that that became a failed structure and I got continuation within there, which I can manage. So then I take a trade here that I can then manage into that point. And then as it broke it impulsively, I've got the next point there. Then I'm just trying to manage it accordingly into that point there. So stops would be protected around about there, and then essentially, or even above, just to be a little bit more safer. And then as it follows through, I can scale into the positions and so forth. So I would take structures such as, in the sense of a short and long, I would look at a structure like this on multiple different time frames. I would look at one which could, actually I'll just draw it down here. I would look at one which was like this. And then what's happened is you had a little bit of liquidity there. You had your 1, 2, 3 internal structure into that point, and then I would look at taking advantage of that sequence on multiple different time frames. I could have something like this, where it's the same thing where, let's say I've got a little bit of liquidity there, value area, we've got gaps, we've got another gap, and then eventually it comes in and takes out that area and sells. And then you basically just got this whole range here. It comes in different forms, but what I'm basically looking at is trading psychology. It's the same thing I just explained here. You've got the little bit of liquidity, you've got the gap, you've got more gaps, and then eventually you took out the liquidity, but we failed to commit. We then we really took it out there at that point, and then we sold off. And then as we broke, we then gave confirmations, we continued. And it's taking advantage of that full psychology. Sometimes the sequence is a lot nicer and you get a lot more continuations. Sometimes it's impulsive and we just have to let it go and we don't get the trades. But by replicating and repeating that process, we tend to make a lot more money. Let's see. What's your view on the DXY for this week's possibility for a long or short? Okay, good question actually, because I was just looking at it. I think we're actually still going long and we can't really hold a strong bias at this point. And I'll just quickly flip the screen right here. So what we can see here is price got liquidity there. We've got a clear point above and we squeezed into it for 1, 2, 3 here. Right, that's squeezed into it now. But how is it squeezed? Well, the origin of it was here, which actually created a double bottom. So then you ask yourself, where's the top of that range? Top of the range is there. How did we get there? Well, we sold off aggressively. We correctively came in. We then tapped in, created the base, and now we're correctively squeezing back up to that point there. So then when you evaluate this, this is premature. This is actually not as significant as that point there because that's the origin. So then I've come to the realization, if I just clear this off again, that we have two bases. We're now waiting for this to kind of come back up. So this needs to do whatever it needs to do. Could even just do that and then eventually make its way up and then come in and sell. And then the beautiful thing about it is you'll have a great sequence on the way down and you can take advantage of that overall run. So I think big sales are coming. I just think that we need to be a bit patient with how we're doing it. If we get structure in here to go long, you can take advantage of the long. If you don't get the structure, and for example, if you did get something like this where it just sold and you had that, then yeah, just sell that, because sometimes the market doesn't, it's not perfect. The market does have enough technically right now to dictate this could sell and trade into those areas before we come back up. Right, that's a strong possibility as well. So I wouldn't hesitate. As long as this idea of a long is invalidated right now, there's no point us looking for shorts. What we'd want to see is that's your line in the sand there. If price respects it and does something like that, then great, you can get involved on the long here, on that structure there. If it doesn't respect it and it just sells through and it comes down here, then you can trade it into the next inflection points down here. So then you can take advantage of that for the short. So keep a neutral mindset on that. I was on IB's live on Saturday. He explained the US market and oil correlation. So the US oil have, okay, so the US oil doesn't control the currency of America in its entirety, but it does correlate in the sense that, you know, if the American economy is not doing so well, we won't see America's oil doing so well either. Because how it usually works is these commodities work as something to help them stabilize their currency. For example, if the price of oil is if inflation is very high and people can't afford to you know, go to work and stuff and whatnot, and the employment rate is really low, oil prices might tend to get higher because less people are buying it, and it means that in order for people to buy more, they're going to have to spend more, right? Whereas if the demand is extremely high, you're going to see that the price starts to drop, right? Until they realize that they don't have much oil and it has to naturally go up. It sounds strange, but for example, see it this way. If you've got a barrel of crude oil, it has an expiration date. So that expiration date will probably be, let's say, in 12 months, right? But once it's pumped out the ground and it's then put into a petrol station, let's say it's got something like 4 weeks, right? Now, let's say that, for example, they need to sell the oil at a certain value. So how oil works is they have certain contracts where they say, okay, well, the current price is $60. I'm going to lock in that $60 for the next 2 years at this price. So I'm going to pay you 2 years worth of value at $60. So if price goes down to $54, it doesn't matter. They're still paying $60 a barrel. So for us as traders, we're just, as retail market who are basically driving and paying for petrol, we pay at whatever they say. You know, they might say it's at 0.60 cents a litre, right? Well, obviously this is a barrel. This is not a litre, but 0.60 cents a litre. So for us, if the economy is, if no one's really buying oil and they've pumped a lot of these barrels and they've got like 6 weeks on it, they need to sell them, so the price is going to drop. The price drops naturally because the demand was increased, but now it's decreased and they have to sell it. But then it gets to the point of, in order for them to stay alive as a company, they need to make money. So what that means now is, let's say everybody's queuing up, like when we had the pandemic, everyone is queuing up to get petrol from the petrol station, right? And basically the petrol is now being used up so much that they need to start pumping more. So now they've got, instead of having, the average barrel, they've got 3 times that amount. If they're pumping 3 times the amount, they know they need to sell it. But the demand is so high, they can only pump so much. They need to now raise the price. So it's no longer $60, the price will go up. This is all consumer driven. It really depends now with tariffs and things going in place, and basically the consumption of oil decreasing because less people are able to do certain things. I wouldn't know the ins and outs of America. The price naturally starts to drop because people are not spending as much. So right now, this probably shows you that there is probably a lack of demand, and that's why the price is quite cheap. But as the demand gets higher, so will the price of the petrol. It's all supply and demand. They're just supplying what they can at $60. But this is how it works now. It's at $60. More people are going to want to get petrol because petrol is cheaper. So the petrol is now cheaper at $60. More people are going to start buying it. When the demand starts to increase, so will the value. And the price of the supply will be much larger. They'll have a larger supply of petrol. And as the supply increases, so does the demand. And then when the demand increases, so will the price. So right now they've got, this amount for 12 months pumped out the ground, and people are buying this like crazy. What's going to happen is as more and more people want it, this price goes up. Sorry, I know that was a bit of a long-winded explanation, but you can see there's not much correlation. Like if the US dollar currency is going lower, then the value of the barrel is lower naturally as well. It's $60, right? A barrel. So for example, if the dollar's like losing a lot of value, the barrels are actually becoming a lot cheaper, even though it's holding its value. So, I'm not really bothered about the correlation between US oil and the DXY. I just know that if the DXY is getting cheaper, people don't have much money, and the petrol prices will be coming across more expensive. So the natural way to kind of keep the economy afloat is to bring the value of petrol lower, so that as their money is losing value, the petrol cost is not going to be losing its value. It's not going to be increasing in value. It's kind of stabilizing, and that's the best way to see it. So, again, economically, if you look at this on a technical basis and forget all the economics and the correlations and stuff, because you don't really need to be worried and think about that too much. You can just see there was a base down here, we had a gap, we came up, we took out all of this random liquidity there as well. We then came down, continuation, we broke that, we retested with another continuation here. So it was correction into a correction, which is basically showing exhaustion. This is now just doing its thing, and I wouldn't be surprised if we even had another one there, and that becomes another correction, and then we go, and then we're there, and then that just becomes one corrective channel in itself. So you can just see like very simple price action technicals on it. It's just, it's not moving in the best sort of sequence. Like this was a little bit nicer, I'll be honest with you. Why? Because once we tapped into all of this liquidity here, even though that it was corrective, it was a lot more sharp. We moved from 80 to 65 in a process of from January the 15th all the way down to March the 10th. From here, we've moved from, let's just say borderline about 78 to where we are now, 58. It's taken around about since, June to October. So it's almost an extended month period of time. Obviously that's a lot of a bigger move now. It's almost a quarter more, but in terms of the same sort of price action, you can see that within here there was a lot more intricate lower time frame scaling opportunities here. They're more on the 4 hour to get the optimal trade entries. Obviously there was intraday trades in there, but they're like scalps, quick in and out. So yeah. Anyway guys, I've now wrapped this one for about 100 minutes. Any last questions before I end this video? it was the first YouTube live that I've done on this, so yeah, hopefully the next one will be even better. Let's have a little look if I missed any questions. What is that? Green screen. All right, sweet. Don't think there's any more questions, guys. Look, thanks for jumping on. I think what I'll do is I will end it with a song that I'll play on the piano. Let's see, what song should I play? Any requests? Oh no, let me play some Frank Ocean. It's like a piano song. Oh, green screen. Wait a second. Let's go. Yeah, I know. From trader to piano artist. Yeah, man, that was basically it. All right, guys, cheers. Have a good one. Appreciate it.